Hi guys, welcome to 365 days, 365 concepts. The concept that we're going to understand today is active investment versus passive investment. First, let us start to discuss what exactly do you mean by passive investment. Now, sir, we all are aware there's an index which is called as Nifty 50, which represents the market's performance, right? If we say that the market is going up, that means Nifty is going up. If the market is going down, that means Nifty is going down. Sir, what is this, sir? It is a portfolio of 50 stocks. Okay, sir. Can I invest in this? Sir, it is an index. It is simply representing the market's performance. It is not something that is trading on the exchange. Like how the stock of Tata Motors or some other stock is trading on the exchange. Sir, this is not trading on the exchange. It is just a mere representation of the market, which consists of 50 stock in a portfolio. Okay, sir, I want to invest in this. What do I do? Array, simply buy these 50 stocks and create a portfolio of them, right? Array, but sir, in what proportion to buy? Array, sir, if what if one stock goes out of Nifty 50, other stock comes into Nifty 50? Sir, there are so many things that I might have to take care of. What do I do? Sir, I invest in a fund. I invest in a fund which replicates the performance of Nifty 50. Sir, meaning, sir, there is a fund which is called as SBI Nifty 50 Exchange Traded Fund. Basically, the unit of this fund can be traded on the exchange. Sir, this fund invests or has created a portfolio which is of 50 stocks that is exactly like Nifty and in the exact same proportion. What happens because of this? Sir, because of this, I get to invest in Nifty 50, which is a portfolio, which I wanted to invest in. And that is what passive investment is, whereby the manager of the fund where I have invested, basically SBI Nifty 50, sir, that manager is not making any effort to actively look for stocks, to research about stocks, to try and find companies where they can invest. It is not doing any of that. It is simply replicating the Nifty 50 portfolio. So replicating means, whatever Nifty 50 shares are there, whatever stocks are there in Nifty 50, it is simply buying those stocks in the exact same proportion. And that is what passive investment strategy is, where the manager is not actively looking out for something, is not doing its own research, is simply replicating whatever is happening with Nifty. Right? There is no active effort here. So, sir, what is active investment, sir? Here the managers will ultimately do active research, will communicate with the companies, sit with the management, understand their product, understand their vision, try and read about the industry, research about the industry, understand the future prospect of the industry. For example, your automobile, it is evolving a lot currently. There's EV, there's electronic vehicle, then there is your, vehicles running on probably will come in the future, hydrogen fuel, and there's ethanol. There are so many things that are evolving there. So, trying and understanding about the industry, you do all of that active research. Why do you do all of that active research? Because you want to outperform the market. Because as a manager, you want to earn more money for your clients than what the index is giving as a return, than what the market on an average is earning. You want that excess return. What do you want? You want that excess return. So managers actively seek out for securities that will give them excess return. How do they do that? Sir, they do their active research. Sir, they communicate with the companies. Sir, they understand the industry. Sir, they understand the industry prospects. They predict all of that. And sir, whenever there will be more effort, naturally, the managers who are doing an active investment strategy will obviously charge higher management costs. And obviously, sir, the transaction costs are also going to be much more. Sir, transaction cost meaning, sir, whatever brokerage, example, the brokerage that you pay. Sir, whenever I'm doing passive investment, I'm simply buying whatever is there in Nifty. Sir, the stocks in Nifty are not going to change a lot. Whatever 50 shares are there, they are going to remain constant for a very long time. But sir, in active investment strategy, I will obviously buy something, I will sell something, I will buy something, I will sell something, because it's an active process to look out for that stock. So sir, naturally, sir, management fees is going to be high. because the person is making an active effort, hence he will demand more fees. But apart from that, sir, transaction cost is also going to be high. Reason, sir, because example brokerage, because in active investment I will constantly buy some stock, sell some stock. Why would I sell the stock? Because I don't believe it in anymore, believe in that stock anymore. Some reasons that are there, whatever it is, my prediction has gone wrong, the management is not that good, what I predicted, all of those things are there. So naturally, when I buy and sell more, the brokerage will be more, as opposed to just doing a passive investment strategy where the brokerage will not be a lot more, and brokerage is a transaction cost. So that was an active investment. That was active investment versus passive investment. I hope you guys liked this video. Please like, share, comment, and subscribe. And if there are any doubts, feel free to ask in the comment section, and I will reply. Thank you so much. Bye bye. I'll see you with another concept.